So, you missed the rally, did you? Is the fear of missing out gripping the markets? Or are we at the second leg of the rally that started at the beginning of this year? This Friday, we saw a big uptick in the markets overall, but the Dow and small caps led the way higher. What does this mean? But more importantly, what might it mean going forward? Before we jump into the charts and analysis, I've been working on the script for my next video about value versus growth investing. And it's my belief the action in the markets on Friday was caused by value investors feeling like they missed the rally. So they jumped in with both feet and bought the underperformers. Well, I can tell you that won't work out well for them in the long term, and we'll talk about that a little more later in this video and in my upcoming video that I mentioned earlier. Look, I'm not trying to diss value investors. Please don't unsubscribe from my channel because I'm talking about value investing not working. Most investors are value investors. Look, there are some things I found in my research that show that's not necessarily the best approach all the time when it comes to investing in companies. And I'll discuss that in great detail in the video that I'm going to produce in the next several weeks. Not sure what I'm going to title it yet, but you'll know it when you see it. But for now, let's take a look at what we're seeing in the charts and the data right now. So normally when we look at these charts in my videos, I tend to look at the 5-day or 1 week charts first, but I'm going to look at just Friday, and I'm leaving ARK off of this for right now. And I'm looking at Friday for a reason. What happened on Friday? We had a big up move in the markets, as any of you who are watching the markets know. But look at what happened here. So what led the way up? Well, small caps finished the day the best, followed by the Dow, followed by the S&P, followed by the NASDAQ. And any of you who've been following my videos know that I would say this is an unhealthy rally, at least because of the Dow finished higher than everything else. The small caps are okay. But why did this happen? Well, if we think about it, over the longer term, and let's throw ARK in here just to make it complete. So you can see that small caps in the Dow beat everything, S&P, ARK, and the NASDAQ. Well, why do I say that this is normally an unhealthy rally? Well, a healthy rally would look something like this, where you have the higher risk stocks leading the way higher, with ARK and the NASDAQ and small caps leading the way higher, and the S&P 500 and the Dow lagging. This is a healthy looking rally. So why do I think this happened on Friday? Well, I think a lot of investors have been watching this market go up and up and up over the past several months, year to date, and they're feeling like they missed out. So they looked around and said, well, the NASDAQ's gone up a lot. ARK Invest has gone up a lot. What hasn't gone up a lot? Well, if we look year to date, the Dow and the small caps are lagging in a big way here. You can see that they're right at the bottom of this. So now investors are piling into those thinking, well, I missed out on all this great action up here. So now I'm going to take these ones that have been lagging and jump onto those because, of course, they're selling at a better value to the market. So let's go back to 1 month and see how things look over the past month. Over the past month, we've got a very healthy rally here with ARK and the NASDAQ leading the way. Now you can see small caps have bounced up here because of the big move on Friday, followed by the S&P. And then if I can get that cursor out of the way, you can't. Followed by the Dow. And then again, year to date, very healthy rally with the highest risk stocks leading the way higher. This looks great. And how do the current bottom dynamics look? Well, you can see that we've had a long sideways move here as we approached the debt ceiling. It became clear back here that the debt ceiling was going to probably get resolved, and you can see the markets moved higher. Now, the bottom forming indicator is dropping. The bottom confirmation indicator is rising here, and the confidence level, the risk confidence level, is moving higher. This looks good going forward. And if I had to guess, I'd say the markets will probably go up next week. Maybe the early part of the week, maybe for the week. Who knows? And then when we look at risk versus opportunity, you can see that the risk level, this red line, has been falling. Now, more recently, it started going higher, but it's still well below a level that would give me concern. I get concerned when this level gets above 80, as it was back here and as it was back here. When it's below 80, I really don't have much concern here. Now, the risk acceleration, you can see, has been moving higher. But again, it's at 50. I don't really care about this until it gets at least above 60 or higher. And while it's moving in the wrong direction, this is going to move around a lot. As you can see, it's very volatile. It's shorter term in its outlook, and it can oscillate quite a bit. But the fact that it's down here at 50, I have no concerns. And I do like the fact that the opportunity level, you can see, has been sort of trending higher and then is pointing higher with the big move up on Friday. So this looks pretty healthy. I think this looks great. Now we're getting into the good stuff. So if we take a look at equity versus safety, you can see that the NASDAQ 100 has stayed in the number one position for the last 3 weeks, and I think it was in the number one position even before that. I really like the fact that we've got the NASDAQ 100, small caps, SPY, and Dow in this order. This is a very healthy equity market, and you can see that we have a very healthy Treasury market with the longer duration Treasuries ranked ahead of the shorter duration Treasuries for the most part, and cash is sitting right in the middle. I'd like to see cash move lower, but I'm happy with it here. This is a very healthy looking market overall. And what has cash been doing? Well, cash was up here, which gave me concern. Then it dropped, then it moved up, and now it has moved even lower. So I like the trend for cash. This is telling me the equity markets are getting healthier. And how does this show up in the buying and selling pressure? Well, you can see what's happened here. On Friday, the Dow shot straight up after just dragging down over several weeks. And you can see what's happened with the buying and selling pressure. The selling pressure, the solid orange line, was above the buying pressure. And then on Friday, they swapped positions. So this is starting to look better. What about the S&P 500? Well, the S&P 500 has been performing better. You can see it's been trending higher, and then more recently has trended really much higher. And the buying pressure is above the selling pressure, although not by a lot. But if it keeps going in this direction, that will be very good. And what about the NASDAQ 100? Well, the NASDAQ 100 has been on just a wonderful rally here, and you can see that overall. The buying pressure, this gray line, has been stubbornly above the selling pressure, which is what you want to see, and it's moving higher. So this looks great. And then if we look at ARK Invest, you can see we've had a very strong rally recently, and again, the buying pressure staying stubbornly above the selling pressure. This is a very healthy looking equity market. And I don't mean to leave the Russell 2000 out, but I tend to put less emphasis on this. But you can see what happened here again on Friday. The value investors jumped in and said, wait a minute, I'm missing this rally. What can I buy that hasn't gone up as much? And they just dove into the small caps. And you can see that here. The selling pressure was well above the buying pressure. It was struggling. And then on Friday, the selling pressure collapsed and the buying pressure really jumped up here. So this is very good looking. Now let's take a look at the sector rankings, because this gives you a sort of a more complete story of what's going on across all the markets: equity, treasuries, safety, commodities. What else do we have in here? Cash, gold. So this is a very complete look at the markets. And you can see here that on the top, I've got the sector rankings from last week. And on the bottom, I have the sector rankings from this week. Now, you can see where we are. We've got the highest risk investments right at the top: Bitcoin, technology, semiconductor technology, ARK Innovation, consumer discretionary. This is extremely healthy looking. We've got cash down here, although I'd like to see it even lower. And we've got consumer staples way down here at the bottom, healthcare down here at the bottom, utilities down here at the bottom. These are all safe haven sectors, and I love the fact that they're down here. So this is looking very, very healthy here. Now, the one thing I would say that I might not like is the fact that cash moved up a little bit. But remember, cash doesn't move. Cash stays flat. Things move around and cause cash to look better or worse. So the fact that this has moved up a little bit, gives me a little bit of concern. But what gives me more concern is the next slide. So if we look at sector rank acceleration, again, if we look at last week, we had clean energy and semiconductors right up here at the top, small caps here. This is great. We had consumer discretionary here. This looked pretty good. We've got technology here. So this looked really pretty good. I didn't like the fact that cash was up here, but now if we fast forward to this week, cash has moved up into the number one position. I'm not sure how this is going to play out. Like I said, cash doesn't move. Everything else moves around it. So hopefully next week when we look at this, cash will be down here somewhere. But we'll have to wait and see. But, this looks pretty good other than cash being up here. We've got clean energy up here. We've got emerging companies here. We've got emerging companies in tech here. And we've got technology here. So, and consumer discretionary is still well above consumer staples. So this looks pretty good. We'll have to see how this plays out. And what if we look at treasuries? So how have treasuries done over the past week? Well, if we take a look at this, this is a very healthy treasury market. You can see the highest risk, longest duration treasuries, the purple line, EDV, have performed the best over the past week, followed by TLT, followed by IEF, followed by IEI, and finally followed by SHY. So these are in perfect order of risk and look very, very healthy. What about over the past month? Well, over the past month, fairly unhealthy, which is why I was saying treasuries look like they were quite a bargain back here. And in fact, we moved our clients into slightly longer duration overall in their safety portfolios by moving more longer duration treasuries into the mix. And then if we look at year to date, again, really kind of treasuries have gone nowhere until recently. So hopefully this turns out to be a good time to be investing in longer duration treasuries, but there's no guarantees here. It just looks like a good opportunity to me over the long term. And what about that inverted yield curve? Yep. Yeah, man, this is unbelievable. So you can see back here, we were inverted by 1.1% or 110 basis points, which is insanity. And then we got a really nice recovery bounce here, and things started moving in the right direction. Here we were minus 40 basis points inverted. And then you can see recently, again, this is collapsing, and we're at 81.5 basis points inversion. This has got to eventually move all the way up here off the chart into positive territory, so we're no longer inverted. I don't know if this is in response to some of the recent Fed comments, but if we take a look at what the markets think of the Fed, the markets think there's a 74% chance that the Fed will leave rates unchanged on June 14th, and a 25% chance that the Fed will actually raise rates by 0.25%. So the markets aren't following that logic that the Fed's going to keep raising rates. And if you look at the Fed versus the rest of the world, they are way higher in the interest rate targets for the most part than the entire rest of the world. So I think, they've gotten ahead of themselves. I'll talk about that at the end of the video. Let's leave it at that. And how do treasuries look when it comes to buying and selling pressure? Well, I said last week that the prices were collapsing, and you can see that in every one of these graphs. Prices were collapsing. But what I did like, if you looked at the shorter duration treasuries, the selling pressure was way above the buying pressure back here. And again, it was that way here, which are a little bit longer duration. But when you looked at even longer duration, The selling pressure peaked out back here and was collapsing. Same here. So I thought that looked good for Treasuries going forward, and as it turns out, that was correct. You can see what happened here. Selling pressure collapsed, buying pressure increasing, price moving higher. Same thing here, same thing here, and same thing here. So hopefully this trend will continue and we'll get a nice rally in Treasuries over the next coming weeks and months. How's gold looking? Well, gold, yeah, might be better to go mine it than invest in it. This has been on a downward trend. Now you can see recently it's tried to kind of rally here, but then just collapsed on Friday. And the selling pressure is below the buying pressure. So the buying pressure is this solid gray line, but the buying pressure was falling off on Friday. And then what about Bitcoin? Well, Bitcoin has just been in a terrible downward move here. And you can see the selling pressure really peaked out back here and then has been falling. But more recently, Bitcoin has started to rally again. And look at what's going on with the buying pressure. It's going up, shooting straight up. So hopefully this trend will continue and Bitcoin will continue to move higher. So where does all of this leave us? Well, if we look over long-term time frames like year to date, the equity markets continue to look very healthy. And now that we're past the debt ceiling crisis, what could our leaders in Washington throw at us to derail things? Well, hopefully the Fed will finally figure out they've raised interest rates too much, too quickly, and too late, after sitting on their hands at the end of the COVID crisis. That's when they had the opportunity to start raising rates at a slower, less disruptive pace, but they missed it. To me, it still looks like there's both a healthy equity risk appetite and a healthy Treasury risk appetite. And maybe, just maybe, we're finally starting to see the investing feast as FOMO takes over. I'm Calvin Rose, and thank you for watching Invest Smarter this week. That's all for now.
Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water.